You're listening to the Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from the Moose on the Loose. I hope you are doing well on Halloween, which is probably my favorite holiday of the year. I don't know. I just love to talk about horror stories and to get into costumes. But actually tonight I'm going to the restaurant, so it's going to be a completely different experience over there. Not really Halloween-esque, but anyways. So I thought of sharing my horror story, and actually it comes from the worst trade I ever made, but that's not the worst part of that. So if you have been following me for a while, you probably know about that worst trade. So I'm going to just do it quickly for those who don't know it. So back in 2003, I started investing. I was fresh out of the university. I got my first job. I borrowed $20,000 on a non-secured line of credit and started trading because I thought, that's the good thing to do when you're in your 20s and you're working in finance and you're smarter than everyone, right? So between 2003 and 2006, I'm selling almost every week. I'm making a lot of money. And then I thought, oh my God, I'm so good at this. I bought my first house, built like $50,000 in cash down just from that $20,000 that I borrowed from the bank. Actually, it started with $3,000 and then 2 months later, it was like $20,000. But anyway, so very successful, was amazing. And in 2006, at that time, my portfolio is up year to date, up 71%. So I'm like, wow, I am so smart. I discovered it all. I just know how the market works. And yeah, I'm a genius. Yeah, the things you tell yourself when you're in your 20s, right? So long story short, I sold my first house. I'm in between houses. I have like my cash down that is sitting in my bank account. And I'm thinking, well, might as well just buy myself a brand new car on top of my new home. So I'm going to put that cash down back into the market and start investing. Still, not the worst decision that I've made so far. Among the plays that I'm looking at, there's always that story where you have a friend where his father is working with somebody else, and that somebody else is working in a mining company, and they're about to discover like some solid metals up north in Quebec. It's going to be amazing. And then everybody's thinking, oh yeah, like that penny stock is going to soar if they discover what they think they will discover over there. So might as well just buy some penny stocks, right? So started to buy massively on that company. Overnight, actually right after lunch, I come back from lunch after like a good laughter and having a good lunch, and then open my brokerage account and I see that I'm down 50%. And first, I don't really believe it. And I'm like, well, it doesn't make any sense for a penny stock to split 50%. So what's going on? It was like not down 52% or down 49%. It was really down 50%. I was like, what's going on? And well, results came in and they discovered squats. So since they discovered nothing, the penny stock just fumbled and eventually lost even more than 50% on that. That's already bad, but the story get worse. I have to buy my new house in about a month or two going forward, and now I don't have enough cash flow to pay for my down payment. But the paperwork is already done. I got approved with that, so I'm like, all right. So I ended up withdrawing money from my RRSP, pay taxed on it because it was not under the RSP withdrawal program for first home buyers. So I had to pay tax on it. Never had the chance to put that money back in. I had to borrow money from my parents to complete the transaction on top of that. So long story short, very costly mistake. And on top of that, now it brought me down to earth, if there was one thing, because I felt very dumb. And I thought, well, I'm not a genius after all. I'm not that smart. And I made a huge mistake. But the mistake was not to leverage. The mistake was not to buy penny stocks. the mistake was not to play around with my cash down. I mean, those were like all mistakes, of course, but the biggest mistake of all, and the reason why I'm coming back with this story today, even though you probably heard the first part, you didn't hear the last part of that story. And the last part is where the horror is being made. Back then, the market was easy. A monkey was making money on the stock market, right? So I was part of those monkeys. I was making money without really realizing that I didn't have any strategy. I just thought, yeah, I'm just going to do some quick research, buy and sell, make quick profit, and then move on, rinse and repeat, and that's it. I thought that was an investing strategy, like really. And then I realized it's not. It's just pure fluke. It was just like being in the market at the right timing, just being lucky, basically. Yeah, a little bit of research. So that boosted returns overall. But I could have like done like a normal return and still having no strategy over there because the market was just going up every single day between 2003 and 2006. So when I think about the stock market today, it seems like it's really similar to what I've seen in 2017, what I've seen in 2003 to 2006, where it was like almost too easy to make money when you invest. So then you forget about your principles, you forget about your rules. You don't even think you need rules, or you think you have rules, but you don't even have some. You're just like investing and thinking that you're smarter because it's super easy to make money. And then as I age, as I grown up as an investor, I realized that it's super important to have a clear strategy. That clear strategy will tell you when to buy, will tell you when to sell, will tell you not to panic, and will make sure that you are always in control. Most importantly, it will also make sure that I reach my financial goals. I mean, from day one, if I was about to buy a house, there's no way I should have invested that money in the stock market. Even if it was in blue chip company, that was just stupid. I would have like, imagine like someone does that right before Lehman Brothers in 2008 declare bankruptcy. That would have been a catastrophe, right? Even if you have like the best solid stocks, they would have been down anyway. So having a strategy, knowing what you own and why you own it for the long run, not for the next 3 months, but for the long run, is a lot more important. And that's how today I am able to always be 100% invested in stocks and always sleep well at night, because I know that my target is not the next 10 months. It's not even the next 10 years. It's like thinking I'm 43 now. What's going to happen when I'll be 85, like in 40 years from now? And then when I look at stocks, it just take away the struggle of like, oh, maybe it's not the right time to buy, I'm going to wait a little bit more. Or maybe it's not the right time to sell, I'm going to wait until it recovers. So the lesson here, if you want to avoid major horror stories, is to take a moment today and lay out your investing strategy. Do not rely on people that you listen to podcasts, you watch on YouTube. Do not rely on whatever you read or whatever you like, somebody else telling you something. Just make sure that you own your strategy and you know where you're going with that. Once you will do this, you'll see how easy it is to make investment decision and how comfortable you are making those. So back then I was really comfortable making those decisions, but I had no clue the impact of them. And then when things were not that easy, that was pretty scary. So, all right, Moose, that's enough for today. Enjoy your Halloween. We're going to talk again tomorrow. And until then, don't forget to, of course, stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose on the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.